In this session, we'll cover the concepts of enterprise value and equity value. These are likely the most important concepts that we'll learn in the 201 course or in your technical interview courses. Enterprise value, often referred to as firm value, and equity value or shareholder value, these are the frequently used terms. But how are they different? In fact, even trained analysts or bankers or accountants, they also struggle to provide a very clear explanation when asked about these concepts. It's a topic I've also found quite confusing for a long time. But first, the commonality between these two concepts is that they both refer to the value of a company. So in other words, they are both types of company valuation. But what are we trying to calculate right now? What is our ultimate goal? Well, our ultimate goal is to determine the value of equity. So we want to know the share prices, the correct stock prices. That's our ultimate goal. And after getting that number, we want to compare it to the current market price so that we can make an investment decision whether to buy or whether to sell, whether to just stay and hold our current status. But in short, our final target is equity value. However, of course, for various reasons I'll explain later, enterprise value becomes, it's unavoidable when performing company valuations. Enterprise value and equity value, they differ in two key aspects. So let's start with the definition of enterprise value. So enterprise value, it represents the operating value and for all investors. So by all investors, we mean not only the shareholders, but we also mean the creditors as well. And by focusing on operating value, it means that we're excluding non-operating assets, such as investment assets, real estate assets, something like that. So non-operating assets we're going to exclude. In contrast, equity value by definition, so the point of view, the standing point of view is from the common stock shareholders. So we're looking at from the shareholders' perspective. Unlike enterprise value, we also include non-operating items as well when we consider equity value. So this concept, it becomes much more easier to understand when we link it to the income statement. So what part of the income statement feels similar to enterprise value? It's the operating value from the perspective of all investors. So it corresponds well to EBIT or operating income, operating profit, or EBITDA. These kind of items, whatever you call it, they correspond very well to the concept of enterprise value. On the other hand, in this side, what corresponds well with equity value? Here we have net income. So net income is from the common stock shareholders' point of view, and it also includes non-operating income as well. So net income or EPS, those kind of items, they correlate very well with the equity value. That's why you've probably heard of metrics such as EV/EBIT or EV/EBITDA, which we'll study later, but we've never heard of anything like EV to net income or EV to EPS because these don't align with the enterprise value perspective. On the other hand, equity value divided by net income, we call it PE ratio or price to earnings ratio or PER. But on the other hand, we don't have metrics like price to EBIT or price to EBITDA simply because the concepts does not match. And in addition to that, we have more concepts that are related to the entire investors. In DCF concepts, we do have the terminology called free cash flow to the firm, which is free cash flow from all investors' point of view. On this side, we have free cash flow to equity, which represents free cash flow from the shareholder's point of view. Again, we have weighted average cost of capital, which is the average cost of capital from all investors' point of view. On this side, we have cost of equity, which is the cost for the shareholders. So how can these numbers be calculated in actual practice? So equity value, as previously explained, it can be determined in two ways. For the book value of equity value, we can always go to the balance sheet. So we can go to the 10K or annual report or whatever you have. You can go there and you can look for shareholders' equity, and that's the book value of equity value. And for the market value of equity value, as most of you already know, we can check the company's market capitalization. So it's relatively easy to obtain equity value. But on the other hand, enterprise value is not easily found. It should be generally calculated using these formula. So the basic formula, it looks like this: enterprise value equals equity value plus debt value minus cash. So by adding the debt value, it accounts for the value from the perspective of all investors. However, one important thing worth noting is that the enterprise value, it typically refers to market value. So when using this specific formula, all of the components should also be based on market value as well. So therefore, equity value, we should use market cap, and both debt value and cash, they should ideally reflect their market values as well. But in actual practice, the difference between book value and market value for debt and cash, it's not usually that significant. So, and additionally, in addition to that, obtaining accurate market value data for these components, it's very challenging. So as a result, book values are often used instead. So with this approach, calculating enterprise value may require some effort, but it's not really super hard to determine. But here's a very important question, and some interviewers in technical interviews do ask this specific question: why do we subtract cash at the end of the formula? Because according to the formula, if a company has a substantial amount of cash, ironically, if we put it into this formula, enterprise value would go down. So because usually, having a huge cash reserve, it's undoubtedly beneficial for the company, but what's happening here? Why does enterprise value decline? So the reason for subtracting cash in the formula can be explained from two perspectives. The first, cash can be used to pay down debt. So by reducing the cash balance, we can actually lower the debt value. So they're going to be offsetted to each other. But more importantly, as we've mentioned earlier, enterprise value focuses solely on the operating value. Is cash an operating asset? Opinions, there are many opinions. It may vary depending on the person or the company. But for the purposes of calculating enterprise value, cash is typically treated as a non-operating asset. So by subtracting cash, we are effectively excluding non-operating assets from the calculation. And what actually happens is that because equity value's market value, in other words, market cap, it's going to increase and decrease whether by the fact that the company has more cash or less cash. So what we're actually doing here is by subtracting cash at the end, it it erases the cash portion when calculating enterprise value. So what I'm trying to say is the more cash you have, equity value is going to increase, but at the same time, cash is going to increase. So they're going to be offsetted. So technically, whether you have more cash or less cash, because it's a non-operating asset, enterprise value is going to remain the same. And similarly, other non-operating assets can be treated as the same way. So unfortunately, enterprise value differ among analysts. The numbers are very different from analyst to analyst, or from service provider to other service providers. Enterprise value is slightly different, but if we are clearly understanding the concept of enterprise value, it will be much easier to use enterprise value in our works or to review others' calculations without major confusions. So to reiterate, enterprise value represents operating value from the perspective of all investors, while equity value includes both the operating value and non-operating value from the perspective of common shareholders. And lastly, let's briefly discuss how enterprise value and equity value align with certain financial metrics. So as I mentioned before, enterprise value, because it's from the all investors perspective point of view, it matches well with EBIT, EBITDA. Equity value goes well with net income or EPS. We have free cash flow to the firm. We have free cash flow to equity. The same applies for the discount rates, which we call weighted average cost of capital, or in other words, WACC. It represents average cost of capital from all investors. And here we have cost of equity, which is the cost for the shareholders' perspective. And similarly, we have concepts like return on invested capital, return on assets. These are from the entire investor's point of view. And also we have ROE, the famous ROE, return on equity, which is from the equity investor's point of view. So aligning these metrics to each other is going to become very, very handy when understanding the valuation concepts. And for those of you who are preparing for technical interviews, these concepts frequently appear as standard interview questions. So it would be very beneficial to understand them thoroughly. And additionally, as we progress in our modeling work, enterprise value and equity value is going to appear very frequently. So let's make sure to organize these concepts clearly. And now let's dive into the main topic, valuation.